Significant beneficial owners, SBO, under Section 90. You will see the purpose of Section 90. Section 90 was brought into the Companies Act to make the corporate ownership transparent. The law wants to ensure that the real people who enjoy the benefits of the company are identified, even if they are hiding behind multiple layers of companies or trust or intermediaries. In a simple terms, the idea is to stop shell structures, binomy holdings, and round tripping of funds by asking companies to trace and record their significant beneficial owners, SBOs, regulators, investors, lenders, and enforcement agencies can easily know who is truly in control. This provision is India's step towards meeting the global anti-money laundering standards, like those suggested by the FATF, that is Financial Action Task Force, and also a move to strengthen corporate governance. Who does Section 90 apply to? So, applicability of Section 90. Every company registered in India, either public or private, except those specifically exempted. The entities that have cross-holding in companies such as LLPs, partnerships, or investment vehicles. Every individual or entity that has a significant beneficial interest in a company's shares, voting rights, or control. So it is not enough to know who is shareholder on paper. The company must dig deeper into find out who actually benefits. Now we'll see the key definitions. Significant beneficial owner, SBO. An SBO is a natural person. SBO is a natural person who either directly or indirectly holds 10% or more of shares in a company, or holds 10% or more of voting rights, or has a right to receive 10% or more of dividends or other distributions, or exercise significant influence or control. Significant influence here, significant influence includes rights such as appointing or removing directors, contractual powers to influence decision making, or having the ability to shape the company's policies, and even indirect holding. The section also covers situations where the ownership is not direct, that is indirect. For example, a person A owns 70% in the company, and company X again owns 20% in company Y, and again company Y owns shares in company Z. So here person A can still be considered as an SBO in company Z because the layered ownership. This is called layered ownership. Now we will see register of SBOs. Register of significant beneficial owners. Every company must identify all SBOs connected to it and then maintain a register of SBOs at the registered office and record details, full name, date of birth, nationality, PAN, or other ID, addresses and contact details, nature and extent of beneficial interest. So the register must be available for inspection by the members or any regulatory authorities. Now we'll see the filing requirement, Form Ben2. Once SBO details are identified, companies must report them to the ROC in a Form Ben2. Timeline, within 30 days of receiving the SBO declaration. And any change in the ownership must also be reported through Ben2. Delay in filing attracts fines under Section 90, subsection 4. We'll see the interaction with the other provisions. You see, Section 89 deals with the registered members and beneficial interest in the shares. Section 90 goes further catch real owners. That is the difference. Section 117 ensures SBO filings are also cross-verified through annual returns. Section 90 subsection 4 covers penalties for false declarations or non-maintenance of the register. Now we will see the exemptions and the challenges also. The government has given relief to certain private companies where ownership is already transparent. Because when there is a transparent, then there is an exemption and companies in low risk categories. However, listed companies, financial institutions, and regulated entities must fully comply with. So we can also see the challenges. What are the challenges? Multi-layered shareholding through foreign entities or trusts, or joint holdings and nominee arrangements. Unclear because there is a definition is unclear, significant influence. So in a complex contracts, confidentiality concerns when individuals do not want their identity public. These are all challenges. And what are the best practices for compliance? Conduct periodic ownership audits. Keep KYC details of shareholders updated. Build a compliance SOP for BEN2 reporting. Train directors, auditors, and even CS to spot indirect holdings. And it's better to use digital tools for tracking changes in ownership. Now we'll see the penalties for non-compliance. If a company fails to comply, 1 lakh fine for not maintaining or updating the SBO register, and 5,000 per day for continuing default. Prosecution for false or misleading information. Why Section 90 matters? It improves corporate accountability and protects against money laundering because we are finding the SBO, and it protects against tax evasion and benign holdings. And it also builds trust among investors, lenders, and regulators. It aligns Indian corporate law with global transparency norms because we are finding who is the ultimate beneficial owner, significant beneficial owner. We have two channels, RR Corporates, other channel, RR Legal Talks. Please do subscribe and hit the bell icon so that you will not miss any of our latest videos. Thank you.